I don't know about you, but I do really enjoy getting a deal. And one of the ways to quote unquote get a deal in the stock market is to think about doing something called buy the dip, right? Maybe a stock or an index fund is trading for 20% less than it was a year ago, right? So instead of that suit being $100, it's now $80. But with the stock market, you got to be really, really careful. And most experts would say, you can't do that. It won't work. But you know what? I've been a fee-only financial advisor for over 20 years, and I've found 3 ways that I think can work for many, many of us. But first, I have to share with you a few fundamentals. Now, the idea of buying the dip is really, you know, as I said earlier, the stock's down 20%. And yes, it's good to get a stock at $80 instead of $100. But the real question is, where's it going to be a year from now? Where's it going to be 5 years from now? We won't feel like we got a deal if that stock is trading at $50 a year from now. So we're betting on something called regression to the mean. So, you know, maybe a stock's been at $100 for a period of time, it dips down to 80, and the idea is it's going to bounce back to $100 and keep going up, $120. But you know what? Sometimes that doesn't happen. Oftentimes it does. But sometimes it's not, you know, gee, the market's a little bit soft in the last couple months and people are what's called risk off, and so it's been oversold. But sometimes there's something fundamentally wrong. Something took that stock from $100 to $80. So that's the challenge. And think about companies like Polaroid, think about companies like Blockbuster, think about companies like BlackBerry that used to make smartphones. BlackBerry was the leader. You know, all of these companies at some point were trading at really nice multiples, really nice prices, and they started coming down. And maybe at some point, you know, stock that was $100 is now trading at $5. And people will say, well, what do I have to lose? Well, if you invested $20,000 at $100 a share, or you invested $20,000 at $3 a share, you have the same amount to lose, right? You can lose it all. So I want you to be really, really careful. And you just have to realize that just because something's down doesn't mean that it's going to bounce back, right? And you've heard me talking about timing the market, and timing the market is somebody saying, well, you know, I think the market's high now. I think it's going to go down. So I'm going to sell some of my stock now. And when it goes down, I'm going to buy more. And even more common is when things are scary. And maybe the stock market's down 20% and you think, I think it's going down further. This happened to a lot of people during the pandemic, right? That was the quickest drop of the stock market, a 30% drop in the stock market's history. It was very scary. The US might have entered a recession, a depression. The world might have entered a depression. So when the stock market was down 20 or 30%, a lot of people were saying, well, I'm going to sell now. And when the market's down 50%, I'm going to buy back in. And you know what? That never happened, right? So timing the market, I'm talking about buying the dip, and I'm about to share with you what the strategy is. But timing the market is different than buying the dip. Timing the market, I think you have a 1 in 8 chance of succeeding. And here's why. First, you have to get what's going to happen correct. So in the case of the pandemic, that COVID is going to become a pandemic, it's going to get to the US and it's going to impact our stock, right? So let's say you had a 50-50 chance of that being correct. And people looked and might say, Azul, you're nuts. You know, you have a lot higher of a chance than 50-50 of COVID coming here. But remember, in the past, they've always stopped these things. So I think it was 50-50. You can argue with me, but just stay with me for the sake of this argument. Then you have to ask yourself, what's the stock market going to do when that happens? Pandemic's a great example. The pandemic came here. Let's say you got that right. What's the stock market going to do? Well, initially it got hammered, but then because of all the stimulus that we put on it, the stock market rose, right? So deciding what is the stock market going to do when and if this event happens, and this is any event, is not a slam dunk. It's not as easy as it sounds. There were a lot of folks that said, well, if Donald Trump, and this is not a political statement, I'm just using another example, if Donald Trump won the presidency in 2016, the stock market was going to go down. You know, they got the event right, but they did not get right what the stock market was going to do. So I say you have a coin toss probability of that. So now you're 1 out of 4 likely of getting it right. And even if you do get it right, let's say with the pandemic, you said, okay, here's what I think is going to happen. You know, the pandemic's going to happen. The market's going to go down. Well, okay, so you got your money out before the pandemic, but now you got to decide when to get back in. When the market's down 20%, is that the low? Is 30% the low? And when it started coming back, were you still on the sidelines, right? So it's really, really hard to time the market. But let's get back to buying the dip and how I think buying the dip can work for you. And the first one is, if you're sitting on the sidelines with cash, you know, buying the dip, the reason people do something called dollar cost averaging, let's say you have $100,000 that you want to put into the stock market, you know, rather than make the decision, I'm going to put all $100,000 in today, which actually the studies show that that's your best path. You have like an 80% chance of doing well if you do that. But a lot of people are uncomfortable with that, and that's fine. So rather than put all the money in, you might say, I'm going to put $10,000 a month in each month for 10 months. And what you're hoping for there is during that period of time, there's going to be a dip in the market and you're essentially going to be buying the dip. So dollar cost averaging is one way that I think can be really powerful and can be helpful to folks. So that's the first strategy. Then the next one is the psychological impact of buying the dip. So for instance, for me personally, when the stock market goes down, you know, I'm human too, even though I'm doing this professionally. And I should say none of this is stock market advice. None of this is financial advice for you. But even though this is what, and it can't be financial advice because I don't know your situation. So I implore you to find a fee-only financial advisor and work with him or her. You can find one just by Googling that term, fee-only financial advisor. But, you know, I'm human too. So one of the things I do is I keep a little bit of cash, not much, about 10% of my allocation is in cash. And the sole purpose of that cash is when the stock market goes down, I don't have, and maybe it's a scary time, I don't have to sell something at a loss in order to buy things that are now at lows, that are now deals. Right? So if the stock market goes down by 30%, you know what? That's going to be scary for me too. But if I have some cash, I can buy, quote unquote, some deals. I can buy the dip and it feels less scary for me. Now, I fully know that over a 10-year period, I'm probably better off having that money in the stock market. But for me, psychologically, it's a security blanket. It's a comfort for me, knowing I have a little bit of cash, and if the market goes down, I can buy it at a lower price. So those are the two strategies. The third one, frankly, takes a fair amount of expertise, but that's looking at specific companies, doing your research and saying, you know, what is this company worth? Not what's it trading at now, but what do you think it's worth by doing your analysis? And then putting a margin of safety on it. Let's say let's say the stock's trading at 130 and you do your math and you think the stock's worth $100. And so you go and so it's at 130, you think it's worth 100, but let's put a cushion of safety on it. Let's say 80. So, you know, if it drops down from 130 to 80, maybe you'd be interested in buying that. You have to be careful because there could be something fundamental that's changed. Maybe the CFO unexpectedly quit, and so now you're worried, you know, is there a problem with the financials? Or maybe a new competitor entered the industry, so you have to do that research. But those are three strategies that I think buying the dip, many of us can win by buying the dip using these strategies. Again, consult your own financial advisor, and also take a look at this video up here where I talk about what the net income what the net worth, I'm sorry, and the income is of America's top 20%, top 10%, and top 1%. Take a look there. I'll see you in the next video. Thanks for watching this one. Bye-bye.